Welcome to Skyward Credit Union's Credit Score Enhancement Seminar. Your credit score has a major impact on several areas in your life. Would you like to know who uses credit score, how your credit score affects you, and what you can do to make your score better? Skyward Credit Union presents the Credit Score Enhancement Seminar to help you better understand the credit score process. Whether you have exceptional credit or more colorful credit, learn what you can do to improve your score. There are three major credit reporting agencies: TransUnion, Equifax, and Experian. All have different scoring models. All versions have the same purpose. The scoring models are used to predict the possibility that a loan will become delinquent in the future. The FICO Score was developed in 1956 by engineer Bill Fair and a mathematician, Earl Isaacs. Banks started using the FICO Score in the early 70s, and in 1981, the first FICO credit bureau with a risk score was introduced. Risk scores predict if the borrower is likely to become past due. Your credit score can range anywhere from 350 to 850. As you can see on the chart, if your credit score is 600 or below, there's a 50-50 chance the loan will become delinquent in more than 90 days. If you have a car loan that is 90 days delinquent, there's a good chance it will become a repossession. Credit scores above 700 are less likely to become delinquent. So who uses your credit score? Insurance companies will pull your score to determine the amount of insurance premiums to charge you. Employers may pull your score before hiring you. Landlords will pull your credit. They want to know the risk. Will they get their rent money on time? Utility companies may also pull your credit score to determine if a down payment is required to turn on services. And of course, lenders pull your score to see if you qualify for a loan, and it also determines what rate to charge you.
The FICO score is one factor lenders use to determine the risk level of a borrower. Other factors include your employment history, amount of debt versus income, credit history, and any collateral used. We use the FICO score to determine your loan rate, your loan term, and any down payment requirements. The FICO score is primarily used to help speed up the decision process, not necessarily to approve or deny an applicant. Based on information and underwriting guidelines, lenders can extend credit to you although your score is low, or decline your credit although your score is high. Scores can vary from one credit bureau to another because not all lenders report to all three credit bureaus. The three major credit bureaus, Equifax, Experian, and TransUnion, they get their information, such as how you pay on time or not, from your creditors. Your FICO score is based on the information they have on file for you. We use TransUnion, and we also use the higher of your scores when you're applying jointly. Now, mortgage companies, they pull all three of your credit reports, and they're going to look at the lower of the middle scores if your loan is joint. That's where they're going to get your rate from, and that's why it's important to know what's on each of your reports. Now, this slide shows an example of how we use the score to develop our risk-based lending matrix. You can see here that the higher your score, the better your rate will be. And Teresa's going to show you on the next slide what a savings it can make.
In this example, you can see that if your score is an A+, and if you get a loan for $25,000 on a 72-month term, you will get the lowest rate of 3.14. Your payment amount would be $381.40, and the total of payments with interest is going to be $27,460. Now, on the other hand, if your credit score is low, you're going to get an E score, and for the same loan for $25,000 at 72 months, your rate's going to be 17.45%. Your payment's going to be quite a bit higher at the $562.33. and the total of payments with interest is going to be over $40,000. If your credit score is A+, that's going to save you over $13,000.
Now, we'll discuss this more in detail later, but the FICO score is calculated from a lot of different credit information. There are 5 types of information used to calculate your score at any given time. Your payment history, 35%, capacity, 30%, length of history, 15%, new credit, 10%, and mix of credit, 10%. The percentages in this chart reflect how important each of the categories are in determining how your scores are calculated. A credit report provides a credit summary, which is like a snapshot of all your credit activity going on at once. It helps analyze the most important factors in your credit file, and I'll show you an example of this on the next slide. On this credit summary here, it shows at a glance the number of public records, collections, any negative accounts, negative history, the number of trade lines, the number of revolving accounts, installment loans, mortgages, open accounts, and the number of inquiries. These calculations help provide lenders with a quick picture of your debt, your monthly obligations, and your payment history. Mix of credit counts for about 10% of your score. Having mostly unsecured debt lowers your score. Secured debt poses less risk, so it's going to raise your score. And having a mortgage will also help increase your score. Here's an example of a credit report that shows some variety. The revolving debt here shown is a debt owed that a borrower can repeatedly use and pay back without applying every time, kind of like a credit card, which can pose more risk. The installment debt is a debt that's paid back at a regular specified period of time, like an auto loan or a mortgage. These pose lower risk and they show stability, which is what a creditor is going to be looking for. Capacity. This is the largest factor, making up about 30% of your credit score. Pay available in the credit summary shows the percentage of credit limits that is available to be advanced. Your score increases about 1 point for each 1% you increase your availability. Risk experts advise that people who use more of their limits are more risky, so in short, don't overuse your credit cards. On this credit report, this person has 82% available left on their card limit. This is really good. Your score can increase the more capacity you have. Closing paid off credit limits lowers your capacity, in turn lowering your score. Another tip, even if you pay your credit card off every month, your credit report is going to reflect your account balance at the time your creditor uploaded their information to the credit bureaus. So it could still report a balance even if you just paid it off. Generally, most creditors report information at least once a month.
So what impacts your FICO score? If you are over limit on your credit card, your score will drop 50 points even if your payment is current. Here's an example. As you can see on this one, the first one, Discover, this person has a $7,400 limit that they've already charged $84.55. You want to be careful with your credit cards. You can be over your limit just by $1 and your score will drop 50 points. Public records also impacts your FICO score. Public records include judgments, tax liens, and bankruptcies. Bankruptcies stay on your credit bureau for 7 to 10 years. Unpaid tax liens are indefinite in most cases, but paid tax liens will also remain on your bureau for 7 years. On this slide, here's an example. You can see that this person has a state tax lien for $1,350. Here's another slide. You can see that they also have a civil judgment There's one with Dylan's that's more likely a return check that was never paid back. And also you can see on the very bottom, this person has filed a Chapter 13. Collections also impact your score. Collections are accounts that have been turned over to third-party collection agencies. These are reported for 7 years, even if they are paid. But effective September of 2017, collection agencies can no longer report medical debt that is less than 180 days old. If you have a small medical bill and you disagree with it, it would be best to pay it and dispute it later to prevent a 40 to 50 point hit on your credit report. Here's an example of collections. Typically, collections are medical, utility bills, cell phone companies, or bad checks. You can see on this report a payday loan with Speedy Cash was not paid, and there's also an insurance premium to American Family that was turned over to collections.
Each of your creditors show on your report as a trade line, which provides an ongoing record of the borrower's payment history. To build a positive history, a borrower should strive to have at least 3 to 4 trade lines with at least 2 years of history. The trade lines show both open and closed accounts. Here's an example of a trade line that shows when the account was opened, if it was closed, the payment amount, payment history, the highest credit limit, its limit, and a current balance. Payment history. This is the largest factor of our score, making up about 35% of the credit score. The first thing any lender is going to want to know is, how did you pay your other creditors? Were you late? Late payments aren't an automatic score killer. You have to be over 30 days late before it shows up on your report. Missed payments, regardless of the amount, can take up to 24 months to restore on your credit. If you miss a payment, get current and stay current. The longer you pay your bills on time, the better your score. Now be aware that paying off a collection will not necessarily remove it from your report. It can stay on there for 7 years. Late payments, collections, bankruptcies, judgments, and tax liens all can hurt your score. Scores can vary on how many accounts they've been past due and how delinquent they got. A solid, on-time payment history will help raise that score.
Length of credit is also very important. It's 15% of your credit score. Again, keep your oldest active account open. If you pay off a credit card, leave it open and do not close it. New credit is 10% of your score. The model looks at the number of recently opened accounts and the amounts advanced. Taking on a lot of new debt in a short period of time is not good for your score. Keep in mind it is best not to open new cards at a department store to get the 15% off on your purchase at the register. Most of these cards have a very small limit and will affect your capacity score. You would be better off to get a Skyward low-rate card or Rewards MasterCard with a higher limit.
Inquiries at the bottom of your credit report are the ones you have authorized. There are 2 types of inquiries, soft and hard inquiries. The soft inquiries don't count against you. This is when you check your own credit, insurance inquiries, and those pre-approval offers. Those are not score impacting because they're not credit requests. Lots of hard inquiries will drive down your score. Having no new inquiries shows lenders that you're less likely to open a bunch of new accounts and accumulate a lot of debt. In most cases, all credit inquiries in a 30-day period are considered as just one inquiry. Any additional inquiries can lower your score about 5 points.
So what's not in the FICO score? Your salary, occupation, employer, employment history, age. It doesn't show interest rate on accounts. Doesn't show whether or not someone is participating in credit counseling. It does not show race, color, religion, marital status, sex, or national origin.
Will paying off credit cards and closing the account raise my score? Not necessarily. It can lower your available credit, and you can lose points depending on your history. Again, the number one misconception everyone has is having open credit that needs to be closed. This is a no-no. Closing limits reduces your capacity and it affects your score. When you close an account, you not only lose your available capacity, but you can also lose your oldest trade line, which can hurt you by lowering the length of your credit history. Now, mistakes are sometimes made, and if your credit bureau contains errors, you can file a dispute. You want to first contact the company that provided the error, but you can also do a dispute online or by mail with each of the credit agencies. The best approach is to get a copy of your free credit report online and file a dispute regarding any errors with each of them through their websites. You can even have a consumer statement placed on your credit report if needed. Go to www.annualcreditreport.com to get your free annual credit report, which is sponsored by all three credit bureaus. How can you improve or maintain your credit report? Check your credit. Order your free credit report to check for errors. Make your payments on time. Sign up for your auto pay at the credit union. Pay down your credit card balances, so your availability will increase and it's going to drive up that score. Don't close your credit cards because, as stated earlier, this is going to affect your capacity. Slow down on opening new accounts. Remember to think twice about accepting the 10% discounts at the register. Move revolving debt over to installment debt. This is going to help show stability. And finally, establish a good pay history. If you've missed a payment, get current as soon as you can and stay current.
Thank you. If you have any additional questions, feel free to give us a call at 833-759-1941. We'd be happy to help.